You know that sinking feeling? You get an email that says your application has been denied, or you finally find the car you desperately need, only to be quoted an interest rate that feels more like a punishment than a loan. What if I told you that a single three-digit number is secretly steering your financial life? This isn't a conspiracy. It's your credit score, and not understanding what it means could be costing you a fortune. One study found that simply improving your score from fair to very good could save you over 39,000 in interest over your lifetime. A low credit score is like a constant, slow leak in your wallet, draining your money in ways that are hard to see until it's all added up. Think about that. That's a reliable car, a down payment on a home, a massive boost to your retirement fund. Today we're pulling back the curtain on this so-called secret number, but the other person has a subprime score, say around 550. Their interest rate could rocket up to nearly 19%. They've found a statistical link between lower scores and a higher chance of filing a claim. So a low score can mean paying way more for the same coverage. That difference means they'll pay over $80 more every single month. Landlords check credit all the time when you apply for an apartment, and 850 that predicts how likely you are to pay back a loan on time. Think of it as your financial report card. It's a quick snapshot lenders use to size up your creditworthiness. Both FICO and its main competitor, VantageScore, use a similar recipe with five key ingredients. Understanding these is the first step to turning things around. This is 30% of your score. It's not just about how much debt you have, but how much of your available credit you're using. If you have a credit card with a $10,000 limit and you've charged $9,000, you're using 90% of your available credit. Lenders like to see that you can handle different kinds of credit, like credit cards, revolving credit, and installment loans like car loans or mortgages. That tells lenders you might be stretched thin. A low score can get you an outright no or force you to pay a much bigger security deposit. We drop videos every week with the clear, simple tools you need to get ahead with your money. Generally, the longer you've been managing credit, well, the better. It shows you have a stable track record. Building good credit is all about a few simple, powerful habits. Here is your step-by-step guide. Even utility companies might demand a hefty deposit just to turn on the lights if your credit is shaky. This looks at how many new accounts you've opened lately and how often you are applying for credit. Opening a bunch of new accounts in a short time can look like a sign of financial trouble. The goal is to keep your credit utilization below 30%. So if you have $10,000 in credit limits across all your cards, in some fields, a future employer can even review your credit report, meaning a messy financial history could stand between you and a great job. Over a 5-year loan, that's more than $5,000 in extra interest for the exact same car. And once you know the recipe, you can start giving it much better ingredients. It's a huge barrier to opportunity and a multi-thousand-dollar penalty that follows you everywhere you go. Thousands of dollars just gone, all because of that three-digit number. When lenders see a low score, they see high risk. These companies get information from your banks, credit card companies, and loan providers about your payment habits. The single best thing you can do for your credit is to pay every bill on time, every month. The easiest way to do this? Automate it, but it absolutely will work. These habits are the foundation of a healthy financial life. Set up automatic payments for at least the minimum amount due on everything. It's just a reflection of your habits, and habits can always be changed. If you have any accounts that are behind, get them caught up now. Consistency is everything. If you just do those two things, your score will improve. You have the power to change this number, and when you do, you're not just building a better score. You're building a more secure, less expensive, and more powerful financial future for yourself. You've got this. It starts with understanding that this number touches everything from your car payment to your insurance rates. It continues with taking small, consistent steps. To protect themselves, they charge you more to borrow money. Let's make that real with a car loan. This is a massive 35% of your FICO score. It's a simple record. Did you pay your bills on time? Even one late payment can cause a serious drop in your score and hang around on your report for years. Imagine two people buying the exact same used car with a $20,000 loan. We'll show you what a low score is really costing you in ways you've probably never even thought about, and then we'll give you a clear step by step playbook to take back control. Section 1: The hidden financial drain of a low score, that feeling of rejection when you're denied for a simple credit card. That's just the beginning. Let's start with the obvious one: interest rates. One has a prime credit score, maybe around 700. They could get an interest rate of about 9.06%, and this penalty is everywhere. The average upper for credit cards for people with bad credit can be over 28%, while people with good credit might see rates closer to 21%. That gap means carrying any balance becomes painfully expensive. But the hidden costs don't stop there. Many car and home insurance companies use a special version of your credit score to set your premiums. It can even dictate where you live. When you put it all together, a low credit score isn't just an annoyance. Section 2: Demystifying the secret number. What is a credit score? So, what is this powerful number anyway? At its heart, a credit score is just a number between 300. This score is calculated using info from your credit reports, which are put together by three big companies: Experian, Equifax, and TransUnion. While there are different scoring models, about 90% of lenders use the FICO score to make decisions. First and most important is payment history. Second is amount owed, also called credit utilization. Third is the length of your credit history at 15%. Fourth is your credit mix, which makes up 10%. And finally, new credit is the last 10%. That's the formula. It's not some secret code, it's just math based on those five things. If this is starting to make sense and you are ready to stop leaking money and start building real financial strength, do me a favor and hit that subscribe button. Section 3: Your playbook for taking back control. Knowing how the score works is half the battle. Improving it is the other half, but it's not as hard as you might think. Step 1: Master your on time payments. This is everything. It's the biggest piece of your score at 35%. Step 2: Lower your credit utilization. This is the second biggest factor, and it's the one you can improve the fastest. Step 3: Don't delete your history. It's so tempting to close an old credit card after you pay it off. Resist the urge. Remember, length of credit history is 15% of your score. Closing an old account makes your credit history shorter, which can actually hurt you. A better move is to keep that old, no-fee card open. Use it for one small, recurring purchase like a streaming subscription and pay it off in full every month. This keeps the account active and working for you. Step 4: Be smart about new credit. Every time you apply for a new card or loan, it creates a hard inquiry on your report, which can cause a small temporary dip in your score. One inquiry is no big deal, but applying for 5 different cards in a month looks desperate. Only apply for credit when you actually need it, not just to snag a 10% discount at the mall. Step 5: Be your own watchdog. Mistakes on your credit report are more common than you think. There could be incorrect account info or even fraud happening in your name, and these errors can drag down your score. You are legally entitled to get a free copy of your credit report from all three bureaus every single week from the official government-approved site, annualcreditreport.com. Make a habit of checking your reports at least once a year. If you find something wrong, dispute it with the credit bureau right away. Step 6: Mix it up eventually. This is more of a long-term strategy, but it helps. Having a healthy mix of credit types like a credit card and an installment loan shows lenders you can manage different kinds of financial products. This doesn't mean you should run out and get a loan just for the sake of it, but as your financial life grows, this will happen naturally. And give your score a little boost. Following these steps won't fix your score in a week. It usually takes 3 to 6 months to see real progress. Conclusion: that three-digit number on your credit report can feel like a final grade, a permanent judgment on your past mistakes, but it's not. A low credit score is not a life sentence. It's a temporary problem that has a clear solution. Focus on the two most important things: pay every single bill on time and keep your credit card balances as low as possible.